What's going on out there? It's Tuesday, March 22nd. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. Man, my bracket is so done. Had Tennessee winning it all, Baylor in the Final Four, gone. We did see TCU almost beat Arizona. That would have been a good call, which is meaningless since, again, I'm pretty much out of it. But how great is March Madness? Hey, it's the greatest sport. And it just keeps going and going and going. I mean, you had St. Peter's. You visit that small school. This year, St. Peter's beating Kentucky. Arguably one of the biggest upsets in history of the tournament. Arguably. And they went on to beat Murray State, who was red hot. You have Michigan beating Tennessee, which is a great game. And then what do you have? Great matchups next week. And they just continue. Houston, Arizona is going to be great. Duke, Texas Tech, Kansas, Providence. Providence looks great. Carolina, UCLA. Hard to see any team playing better than North Carolina right now. Miami looks great. They're a 10 seed. But if you really look at their resume, I mean, undefeated against North Carolina teams during the regular season. Think about that. That's North Carolina, Duke, Wake Forest, North Carolina State. I mean, you didn't really know that going in with Miami, but they look awesome. You know, so can't wait till next weekend. Just the greatest sport, the greatest sport. But that said, I didn't get a chance to watch a ton of basketball this weekend because my oldest daughter had her first games for her travel team in basketball, which was in Gainesville. And Gainesville is only 2 hours away. Hear me out. Going to get into a lot of crazy stuff right now, okay? Just telling you this personal story first. Yet, it was 2 hours away, but I had to get a room for the weekend. Since the first game, which is crazy, and we got scheduled a couple days before, the first game is at 7:30 a.m. So there's no way I could drive here and get there unless we were leaving at 5. The next game was at 6 p.m. on Saturday, and then we had a game on Sunday at 1 p.m., right? It doesn't get worse when it comes to scheduling. I know a lot of you do travel stuff. This is my first travel team, and it's insane. It's just insane, the schedule. But the reason why I'm sharing that with you is because when you look at the hotels, there are basically no rooms available in Gainesville. I don't even know what's going on in Gainesville. I don't think there's any basketball going on, for the tournaments and stuff like that. But it was just every hotel was practically booked. So I winded up finding a Best Western, which was a decent hotel, and it was over $300 a night. And almost every single hotel that I looked at was more than $250 a night with fees. So I paid over $600 for the room. Which, by the way, after the first day, I went there, and my wife met me because my other daughter had a gymnastics meet in Georgia, so she met me Saturday for the second game. So she came down, but after we left, I was like, hey, you know what? Could I have someone clean my room? They're like, oh, they left. They're gone for the day. I'm like, what are you talking about? They're like, well, you have to request those services. Since COVID, I said, I'm paying over $300 a night. You can't clean my freaking room. You have to request for you to clean my room. And I asked them when I first got there, I said, can I get a cot? Because my niece came with me, who's also on the team, 13-year-old. So we had, 5 of us staying in a room, which wasn't that big because nothing was available. And they're like, we don't have any cots. Well, we got rid of them during COVID. Like COVID was yesterday, right? I mean, you can't use COVID as an excuse anymore. Come on, you just can't. But they're like, we ordered more cots and we didn't get them in. And I'm like, so you don't have any cots? Are you kidding me? And that's, again, if I was paying $75, $125, I would be like, okay, no problem. You're paying $300 a night right now. And also, if you look at the cost, over $200 in gas, easily, another $200 in food for 5 of us. It was $35 they were charging for the weekend to get into the gym for me and my wife, and then I think it was $10, $15 for my youngest. Daughter and niece, they're playing a tournament, they get in there for free. So we're looking at roughly $1,200 in cost to stay 2 hours away from my house for the weekend. Think about that for a minute. And I want you guys to think about that for a minute. Because if summer comes up and you have your kids doing different things or going to different camps and stuff, the costs are out of control. I'm not sure how people could afford this. I mean, for me, I'm looking to change our habits. I'm looking to change. And if you're looking at the average family out there, how could they afford something like this? And the rest of the team she plays lives in Jacksonville. We're moving to Jacksonville, but our house is going to be built for like another 6 months. So it's like an hour ride for them. So a lot of them didn't have to drive back. They were able to drive back and forth. They didn't have to book a hotel. But it's getting to the point where people are going to start, they're going to say, forget it, I'm not traveling. It's just too expensive. I mean, you look at hotels, airlines. The oil prices did decline, but back over $100. Food prices through the roof. And what these places are charging right now is absolutely insane. It's not sustainable. It's sustainable right now. We're okay right now, but you're starting to see the foundation crack. And you're going to see earnings start to get hit for companies very, very soon as people do change their spending habits. And look, if they can't pass off those higher prices, which some companies, almost all companies have been able to do for now, then what are they going to do? They're going to have to cut expenses. That starts with employees, then marketing budgets, since they're based on a percentage of sales, and maybe they maintain sales or sales go a little higher, but with all the costs going up, if you can't pass on those costs, you're going to see earnings get nailed. And that's not really factored into the stock market right now. I mean, those estimates are super, super, super aggressive. We have Powell saying that, inflation's going to come back down to 2.3% in like 18 months from now. Are you out of your mind? Are you out of your mind right now? That's insane. But we see this when we see those consumers and we say, start closing their wallets, things are going to get ugly. And you have people sitting on a ton of debt. Many people, which look at your neighbors, are living well beyond their means. They got used to that easy money forever, meaning low interest rates, rising salaries, which they had the upper hand in because companies need good workers, and these companies have good, really strong balance sheets. So, okay, we'll pay you for now. That's why you're seeing wages rise. But how long can that continue, especially if you're not seeing on the earnings end? You're going to have to cut costs. You're going to have to cut employees. But if you're looking at inflation, which is the key to all this, it's not going away. It's not going away. Guys, I tracked the statistics from numerous firms and been doing this for the past 2 years since COVID. Seen the ups and downs. No bias here. I'm not trying to scare you. I'm not trying to be optimistic. I look at the data, and that's where I base my decisions on where to invest. That's how I do. That's how I run my business. And you look at the supply chain bottlenecks, and what you're hearing out there is, hey, they're easing. They're easing again. They got worse, and now they're easing again. Okay? You know what? There's truth to that. And according to Goldman, you say that there's 50 ships waiting at docks to unload compared to 100 in January. So it's easing. You're right. It's easing. You know what the average is for those ships, that waiting time for pre-COVID levels? Talk about pre-COVID. So the January, February, before COVID really hit in March in 2020. Again, 50 ships waiting now from 100 in January, but 50 ships waiting. The average is 2. The average is 2. So how do you see inflation easing in the short term based on this data? And remember, these are all those goods trying to get to the places like Nike or whatever. Nike just reported great earnings because they have pricing power. They raise their prices. But it's going to get to the point where you can't raise prices, and they don't have the inventory. Even with commodities and building, it's at 30-year lows inventories. And it takes a long time, especially when it comes to metals and things, and aluminum or whatever. Rare earth metals, stuff like that you just can't turn it on. It's not, oil is a couple of months. Not as bad. You got to get the drilling rigs in place. Starting from scratch takes a little bit longer, but some of these things are capped, or you open up levels of drilling. And these guys can get it done pretty quickly in months where you can get a lot of supply in the market. It's not like that with the metals. It's not like that with most commodities. It's not like that with food. So where do you see prices easing? And these guys don't have anything to sell. They have some stuff to sell, but you're going to see prices continue to rise. Inflation continue to rise. Companies are going to be forced to raise prices in a market where we're going to see wages start tailing off. Because that's where the cuts are going to come first, because that creates an immediate impact. That helps the most. When you cut salaries, that helps the most. And you pay a charge and you pay them over, whatever, how long they've been there and again, severance and stuff. But once, now those costs are off your books, you become a leaner company. But, what are we going to do here? So I'm not sure what's going to change this, at least over the next 6 to 12 months. How does this end? And we could see good news out of Russia and the Ukraine conflict, which may result in oil prices moving a little bit lower here, maybe to $75, $80. But those supply chain bottlenecks, they're not easing anytime soon. No way. 50 ships are still waiting. 50 ships are still waiting. You're still seeing huge demand for so much stuff. You think it's going to change overnight? Are you crazy? And you look at inflation. Inflation is like tearing your Achilles in basketball or any other sport. It doesn't matter who you are. You could be LeBron James. You could be Tom Brady, Roger Federer. It doesn't matter. If you tear it, you're out for a year. That's it. You're out for a year. That doesn't matter who you are, whatever it is, what you could say. You can't do anything about it. With inflation, you can't do anything about it. You can't. You're looking at the market rally, especially in growth stocks, it's done, at least for the next year, maybe longer. The Fed can't come in and help you anymore. They were there at the big punch bowl. You get a bailout. Oh, you need money here. Here's some for your kids. Here's just throwing out money like it's just, hey, here you go, trillions and trillions of dollars. That cures the problem temporarily. It's like the Yankees or Red Sox would do if their team sucks for the first half of the season. Now what do? They spend $200-300 million on the best players and the shittiest teams ahead of the trade deadline to make the playoffs. That's the formula for baseball right now. It sucks, but that's the formula. When you have money, you could spend. When you have money, that cures a lot of problems. Money cannot cure inflation. You have to take money out of the system. You can't cut rates by only 25 basis points. With Powell hoping, right? Hoping that inflation, the problem that you started, just starts easing by itself. It doesn't happen that way. That's why I was making fun last week. People saying, oh, you know what? The Fed, they're not going to raise by that much. Powell doesn't have to raise by that. I can't see them raising by that much. What do you mean you can't? They don't have a choice. It's not like you can sit there and be like, oh, like you really think that if they could really just raise by 25 basis points and control inflation, they would do it. They can't. They know that. That's why how many Fed governors, how many Fed members came out? How many came out over the past few days, right after the Fed meeting, and said it's way too slow. We have to go much. And it's funny because Powell, who testified, who wrote this massive freaking thing, and just again, word for word, reads it off to Congress, all of a sudden came out yesterday out of nowhere and said, oh, we might have to be a little more aggressive. Like, why didn't you say that like a couple of days ago or last week? Why didn't you say it last Wednesday? It's amazing. You had everything written out. What changed from that week to this week? It's the Fed governors going, Powell, you're going to make yourself look like an asshole if you keep this pace, which is 25 basis point hikes. You're going to look like an idiot. You're ruining our credibility. And that's why they all came out and said, we have to go faster and faster and faster because inflation's out of control and it's not going to end unless we take money out of the system. There's no other choice. No other choice. I want to be the bearer of terrible news here. I'm just, again, it's the data. It's reporting to you. That's why I look at these supply chain things. So I knew, the Ford CEO, the GM CEO, they're full of shit a year ago saying that, hey, you know what? 2021, we're good at the end of this year for supply chain issues. That's why we're going to produce all these EVs. Are you kidding me? And we're seeing the people who track this the most are lowering their estimates. And I'm saying the most, like for 25 years, they've been tracking supply chain issues and supply chains all over the world. And they lowered their estimates for car production by 2.5 million, not just for this year, but for 2023, 2024. 2024. Are you kidding me? You know how long that is? 2024? You think you're getting an EV really soon? Good luck. Order it now. You might get it in 18 months if you're lucky. If you're lucky. All those orders for Rivian that came in, those pre-orders, done. Can't get a car out the door. Don't have the parts. Like I said in past podcasts, it's not every sector that's going to be punished. It's not like the market's going to absolutely crash. We're down a lot. There are opportunities out there. And commodities, I continue to buy and pull back. We saw uranium surge, come down. Now it's going back up again. Look at that gold. Gold finally. I mean, come on. If it doesn't make more sense now than ever, even Bitcoin, agriculture stocks, a lot of these are in our portfolio. But if you look at Bitcoin, it's over 42,000 again. 44 level is huge. I mean, how many times have we tested the 44 level since we really broke it down since November? Just hits it, goes below 40. Hits it, goes below 40. If we break the 44 level, the 44,000 level, we're going to go right through 50,000, probably right away. And we will break that level because of that major change, which is Biden's initiative. Because you're looking at Biden, if you're looking at the money, it's important that he came out and said that, hey, the U.S. wants to be the country for innovation when it comes to crypto. And if you look at every major firm and all the most important people that manage the most money in crypto, every one of them came out and said this is great news, even though nothing was done yet. Because Biden could have came out and said, well, we're regulating the whole industry and everything's a security and you're done. Now you're going to see money come into this market almost immediately. We just saw a great deal with Goldman Sachs, signed with Galaxy Digital. Think more custody. You're going to now it's opened up. Now you have that in place. And believe me, there's lots of lobbying dollars for this. Lots of lobbying dollars for this taking place. You know why? For crypto? Because you have $250 trillion in assets under management. $250 trillion under management, and you have all of these clients saying that they want to get into crypto and alternative assets. They want to get in. Even Jamie Dimon said it. Listen, I don't like it, but our clients want it, so we have to offer it. Or they're going to remove their money from your place and go to some place that offers it. That's what they want. That's what they want. Especially in a market that's declining, that's crappy, because now you're taking on even more risk, which is fine. But if you take on that risk, you want to make sure you have those massive returns, which can be offered in crypto, not to mention all the new innovations taking place there. All the new innovation. DeFi, metaverse, security tokens, NFTs. See the latest, Dave & Buster's. Dave & Buster's reported great earnings this week. Stock went up. Just went there this week with my daughter and niece at night. Pretty packed. But they just came out and said they're going to try to start accepting crypto. They started with that, what is FTX exchange? That was kind of like, nobody really talked about that. That's huge. Accepting crypto payments? That's what they're looking to do. That's why they signed that deal. They're partnering with them. That's Dave & Buster's. That's the younger generation. That's where everything's heading. That's where the innovation is taking place. AI is not innovation. AI was innovative 10 years ago, 15 years ago. And then they started building data analytics, 5G. These are trends that are existing that you're building, I'm talking about innovation, changing industries forever, like streaming did. That's what's happening in crypto. That's why everybody wants to invest in it. That's why it's so huge. So for me, I don't care if it breaks the $44,000 level now. I don't really care. What I do know is it's going to go a lot higher in the future. And there's lots of great, great ideas that people can make an absolute fortune on, just like 2021. In 2021, yes, the market did good, but I can't tell you how many big-name cryptos, over 60 I can give you, big-name cryptos that are up well over 1,000% to well over 10,000%, just in 2021 alone. And that includes like the huge decline we saw towards the later half of the year. But if you're going to take on risk and lose 30% in small caps, why not take on risk in crypto? Because your expected return, your potential returns are 5x more than buying traditional small caps. And it is risky, and yes, maybe you lose a little bit more if you don't have a stop, but that's the market, and people see that and say, hey, I want to be in this. This is where everything is going. This is the new generation. The younger generation. This is what they're doing right now. It's not just crypto. It's digital payments, everything. Anyway, you look at inflationary environments. You're looking at real estate's going to do great. Yeah, you're going to see higher interest rates, but still, real estate, the price of real estate that you own is going to go higher and higher. Maybe it's a little tougher to buy a house, which a lot of times increases, is going to work in your home price going higher and have more demand for it. Especially, bigger properties that people pay cash for, which you're seeing tons. I can't tell you how many deals you're seeing, tons of cash. Because if you're looking at big deals where people own their own companies, if they own more than 25%, it's almost impossible for the bank to give you a loan. It doesn't matter if you have $50 million in the bank and you're looking to buy a $2 million house. They don't care. They want to see income. And if you have a 25% stake in any business, they consider that like your company, meaning that if it's reporting losses, it comes right off your income. And a lot of people that make a lot of money, their income, especially if they own companies or publicly traded companies, it could be like $250,000, $300,000, $400,000. Of course, that's a lot of money, but it's not like $5-10 million you see with the banks and stuff like that. But when you have a company losing $500,000, that comes right off your income. It almost says that you don't have a job. But you're like, wait a minute, I have $50 million here. I could buy 25 houses if I want. Nope, it doesn't matter. It says in our algorithm that we can't give you this loan. So I can't tell you how many loans people are using cash. But real estate's a great investment. And also banks. Start buying banks aggressively here. They've been unfairly punished. Earnings are going to explode for these guys. Higher rates lead to increased net interest margins. And you have to listen to the last quarter of, fortunately I have access to this information, and you have firms that just cover the banks that put all these quotes, the top quotes of what the CEOs in this sector said. And you have to see what they're saying about higher interest rates, how much money these guys are going to generate going forward. Massive, massive, massive amounts of margin is going to explode as interest rates go higher. Yet a lot of these things are down. They got crushed along with the pullback in the market. But probably one of my favorite sectors right now in terms of risk-reward standpoint is banks. Throw one in there. We were early in Goldman Sachs. It went all the way up. We had huge gains on it, pulled back about 25%, 30%. We still hold on to it because I think we recommended it around $200 and it went to $400 and whatever it is, like it went to $320, whatever it is right now. But for us, we went so early, pays the whole, Like Goldman, JP Morgan, throw a big bank in your portfolio right now. These things, you're getting a 20-25% discount where it's a certainty that earnings are going to explode for these guys. One of the best places to be in a rising interest rate environment. But be careful out there. Your stocks with high valuations are still dangerous. I mean, it's not easy to grow earnings at the same pace, and it's hard to see that because we're so used to that over the past 10, 11, 12 years since the credit crisis of just the Fed throwing money at it, earnings, projects getting funded, the massive growth. We're not going to see the same pace that we saw in previous years, not with these massive headwinds, not with rates rising, supply chain bottlenecks. And the consumer, which I'm telling you, is going to start reining in their spending soon. They have to. The costs are insane. Anybody listening to this knows. You're seeing the bills that you're paying. It's getting to the point where they're just like, fuck it. Let's charge another $50 fee, another $75 fee. I stayed in Miami 2 weeks ago on business, and Expedia and everything, full price. And then they said, hey, okay, they gave me the key. It was kind of like a hotel / mini condo type thing. It's the only thing that was available. It was actually nice. And they said, hey, you have to stop by the office because you have to pay another $50 fee. I said, what are you talking about? They're like, I said, how come it's not factored in when I booked on Expedia? They're like, well, it's an extra fee. So now you're charging extra fees on top. And I've been using Expedia for easily over a decade, probably 2 decades. And now you're charging. Usually they say the full price, all in. They'll say it says $225 a night, and then it says $280 a night with all the fees, right? And then for 2 nights it adds up. It says this is your full cost. Now I had to go back and pay another fee. I mean, how much could the consumer bear? I mean, could you see the average family paying $8,000 to go to Disney for 5 days? That's the cost. And that's the cost. If you look at a lot of sites that track this stuff, which includes $250 a night for hotels for 5 days, food at Disney, travel back and forth in shuttle buses and also flights. However, what if you want to do something at night with the kids? Blue Man Group, whatever. You want to go shopping, upgrade your room, have fast passes, rent a car, gas, snacks. You can pay $10,000 for 5 days? $10,000. You know how much that is for the average family? I don't even know what the average, the average income per family these days. 50, 60,000? I don't know. Am I off on that? Last time I looked. 10,000 for a vacation to Disney for 5 days? You're not going like to Europe. This is a new reality. This is a new reality. I'm not saying we're not going to see the occasional rally in growth stocks, which we saw last week, but a lot of that's going to be short covering. People on the wrong side. You could tell by the massive volume. So you're not seeing those big long-term funds. They're not putting their money in these names and holding them for years. The algorithms flipping back and forth. You've seen the massive volume. This isn't like, wow, these things are cheap now. Let's jump in and hold on for the next 3-4 years. You're not seeing that. You almost see, it's get to a point where you have to adjust your portfolios. All right, what's going to sustain? How do you keep this sustain? How do we go back to that growth market? What do we need? We need growth catalysts. You need supply chain issues to ease. You need inflation to ease, which is not going to happen in the short term. It just won't. The math is there. It's not going to happen in the short term. Until then, when it comes to growth, it's a sell-the-rip environment, which is a lot different. The opposite environment we had for the last 10 years, which is buy the dip. Just buy the dip. Buy the dip. Fed's there. Buy the dip. Zero interest rates. Buy the dip. Nope, no longer. You don't have zero interest rates. And they're going a lot higher. Especially for Powell to come out today and say, hey, the next meeting we might go 50 basis point hike. Why the hell didn't you say that last week? Because all these governors said, look, you're going to look like an idiot. We already lost credibility to the Fed. We spent all this money. We said it was going to be transitory. We said at 2% we'll start raising. It's 7%, and we just started raising. How is inflation going to get under control unless you raise rates, unless you take money out of the system? It won't. So you got to do it. If you want to do it slow, this is a 3-4 year problem. If you want to do it quick, it's a year problem. It's up to you, but you have to do it. You have to do it. You have no choice. I have some time here, and I'm going to take a question. This is from Ron. I'm taking this question here. Again, just one question because I'm getting a lot on it, and it's a really good question. It's about Disney. So, and I've gotten several questions on it, so that's why I'm taking this one. So he goes, Ron asked, I know you're negative on Disney. I saw the article this week about Disney where Iger and the new CEO, Chapek, don't like each other. So you think that could lead to a change in management in the future, and would that make the stock a buy? The quick answer, yes. So, the quick answer is yes. And when, again, it's about the numbers, the data. It's not like, hey, I hate Disney forever. And I don't hate Disney. I just don't like what the stock price was. And it's down now. It's really, pushing lower. But if you look at the details, there's stories out there about Chapek's response over the Don't Say Gay bill, right? And that's like making news. That's everywhere. And personally, I think it's stories being pushed by insiders at Disney because it's not really a big deal. Not that I don't believe it or not or whatever. A lot of people don't even know what that is. It's being pushed a lot. And I think I really believe it's by the insiders at Disney because they want him out. So here's a guy that now has total control of his spending. Disney right now is the worst financial shape in its history, sitting on $40 billion in net debt. $5 billion of that is due this year, which is a lot considering free cash flow is expected to be just $4.5 billion this year. It seems like a lot of money, $4.5 billion, until you throw in the $33 billion in new content spend that they're projecting. That's their number. They're projecting, and they're going to be projecting that every year for Disney Plus. That's new content. Which is what? We know, a super low margin business, highly competitive. But you look at Disney, it's still a really expensive stock here, even after the sell-off. It's trading at 25 times forward earnings. That's very expensive. I mean, that market multiple usually deserve to be trading much more than the S&P 500 when you're actually seeing massive growth. This company's not seeing that massive growth. But if you look at Chapek, he's behind the scuffle with Scarlett Johansson, where he stopped paying her salary after she's pissed off that Black Widow was available on both streaming and in the movies at the same time, which was not in a contract. And what did this guy do? He attacked Scarlett Johansson, saying that she should be more sensitive to COVID and people are dying. I mean, this is Disney. You don't say shit like that to A-listers. You're Disney. That never happened in the history of Disney. You never saw like a spat between them and an A-lister going back and forth on contract negotiations. No way. They meet with them and say, what do you need? Because you could generate so much more money for us in the future. What can I do for you? And it's not just Black Widow, right? It's Marvel. She's a part of a lot of those. You're really going to piss that person off? But Chapek did that without even consulting Iger. And it's a big deal since Iger, and he says this, he prides himself on having great relationships with A-list superstars. So make no mistake, Iger is Disney. He's a big shareholder, tons of contracts in Hollywood, knows the biggest people. I mean, Steven Spielberg sat his going-away party, Disney last year. Steven Spielberg sat at his table, which is pretty cool. He's the guy who purchased Marvel, Pixar, Lucasfilm, three of the greatest asset purchases you could argue in entertainment industry over the past at least decade, probably longer. And he doesn't like Chapek. So Chapek's contract is due in 2023. That's when it comes up, unless we see Disney get to 230 million plus subscribers next year, and that's Disney Plus from 125 million today, which is the goal. And by the way, they'll probably easily meet that number since they're going to be mostly free names through more partnerships like Verizon. I mean, I got it for free forever. That's why the average revenue per user is the lowest by far, $4 and something compared to what? $16 now for Netflix, average $13, $4 in the industry. But maybe he's able to keep his job because that was a number that did push up Disney at first, especially during COVID. You've seen those numbers go, holy shit, look how many names. Doesn't matter if they're not paying, but they're adding names. Holy cow, that's great. Now those numbers matter. And now when they miss their numbers and Disney, what happened? All the analysts said, oh, you know what? It's not going to be 2021 when they come back. It's going to take another year. So we're not going to change our estimates. It's just going to change. It's going to take another year. I never saw analysts say that for every company ever that missed the earnings estimates. And they reported decent earnings last quarter, but still, it's to me, the numbers are amazing. But this guy, to me, I don't like him. I don't like Chapek. Just talk about, we're going to get into the metaverse. We're going to, figure out streaming first. That's your business. Don't worry about the metaverse. We're going to get into this. We're going to get into that. Just the cockiness. I mean, he should be more like Tim Cook. I mean, Tim Cook took over from Steve Jobs. And what he did, he never disrupted Apple's culture. And yet, he led the company to the biggest, most powerful brand in the world. I mean, to put in perspective, Steve Jobs, this is interesting. Steve Jobs, he stepped down from Apple when he was sick, August 2011. Its market cap was under $400 billion. Its market cap today is $2.7 trillion. I don't know if we would have got there with Steve Jobs, because Steve Jobs hates partnerships. He's more like everything Apple. Maybe, but I don't know. Holy cow. I'm not taking anything away from late Steve Jobs here, but 2.7 trillion, not bad. Without disrupting the culture, everybody loves Apple. It's one of the greatest companies, greatest, consumer products you could buy, the iPhones, the iPads. Chapek is different. He seems more like a loner to me. He wants to change things around, but not in an innovative or good way, since it's pissing off a lot of executives. I mean, going all in on Disney Plus, it's a dangerous strategy. It's going to cost the company tens of billions in expenses. And I get it. You know, you did it to create a Netflix-like multiple, and it was one of the only things you could do since you were most impacted by COVID, since that it's a consumer-driven business, and nobody could travel, nobody can go to plays, nobody can go to the movies. I get it. Let's do stream. We have no choice in going all in. But now that Netflix-like multiple, the growth that growth multiple dynamic, if I should call it, it's clearly changed. Now the Fed's aggressively raising rates and shrinking its balance sheet. That multiple's shrinking. But the Don't Say Gay Bill debacle, I have no doubts being fed by Disney. Insiders, those guys want him out. It's what Iger wants. And from Iger's standpoint, look, it's not easy giving up control of the greatest media brand in the world and watching someone else come in and start pissing off A-listers, restructuring divisions to where everyone from ESPN to Parks has to report to you whenever they want to spend $1. And everyone's looking at these moves, which are being made by Chad. It's not innovative. It's almost to create more power. At least that's the perception, which is obviously disrupting the culture. So with that said, if he's gone by next year, I think Disney is worth buying, especially if they decide to lighten up on Disney Plus. Maybe start licensing out its existing content, which is absolutely massive. They have a ton of it. And every streaming service is dying for or pay a fortune for it right now. They're dying for content. Like I said, existing content, because creating new content is a fortune. And that's what streaming's all about. That's what you need to keep streaming customers engaged to the point that they're not going to cancel. They're going to continue that monthly payment. It's new content. They're not going to stay there to get content that, all the Marvel movies you could see on TNT, which is Time Warner. Endgame. They put all of them. You're not going to subscribe to a service for, again, maybe you want to see a couple of these, but you want to see the new content. That's what keeps you engaged. But throw in strong demand for its parks. They do have pricing power. Movies coming back online in terms of people going to the theaters. You could see some strong growth there, but right now expenses are still huge. Debt is massive. And while they'll likely beat estimates in the quarters ahead, only because the analysts are purposely keeping them as conservative as possible, because it was so freaking wrong on Disney's earnings projections over the past year, you might see that. I mean, Disney's only expected to earn $5.60 in 2023. Okay, so over 18 months from now. Let's put that in perspective. It's less than what the company earned in 2019 pre-COVID. Everybody's earnings are surging. They went to record levels, not Disney. And it's less than what they earned in 2019. Then that's not a fair comparison. Because 2019, they paid $71 billion to acquire Fox's entertainment assets at the top of the market. The right comp is 2018. That's where they peaked in earnings at over $7 a share. They're supposed to generate $5.60 in 2023. How are they going to do that? Spending over $33 billion on new content and charging, $5 a month or whatever for streaming in a highly, highly, highly competitive market. If Chapek gets outed and he decides to start licensing their content or do a license deal with maybe Apple, Google, Amazon, names that can write a $20 billion check like it's nothing and pay royalties for decades and get access to Disney's massive library, to me, that's a solution. That's easy. Now you build up your parks, you build up the theaters, you build up everything, and license your content to the 50 streaming providers that are dying for content instead of you just creating this whole platform. Again, you see the numbers. It's not working. Let's see how long they go on. Eventually, they're going to cut back on Disney Plus and say it's just not worth it. They're going to do that. It's a matter if you want to cut it now, which great companies cut fast. I'm not saying get rid of Disney Plus, but start licensing out some of that content. Instead of paying $33 billion, or you could do it 2, 3, 4 years from now, but you will do it. Trust me, you will do it when it comes to Disney Plus. There's going to be a different strategy there. They need to implement a different strategy because they can't afford to pay $33 billion a year on new content when all their competitors, their largest competitors, are spending the same thing. And companies like Time Warner are generating, $30, $40, $50 billion in free cash flow from so many other businesses. Disney's not doing that. They don't have that recurring revenue stream. But Disney Plus, all the streaming services outside Netflix, Time Warner, I mean, these guys are generating huge cash flow to support the new content spend. It's just a terrible business, and Disney has to change, and I think Chapek is going to be out by next year. That's my prediction. And if it is, then Disney's going to be a very, very strong buy. So, guys, that's it for me. Questions, comments, feel free to email at frank@curzioresearch.com. That's frank@curzioresearch.com. We'll be on with Daniel tomorrow. Really exciting stuff, breaking down the markets. That's getting a lot of traction. Everybody likes that one with Daniel and I going back and forth and debating the hot topics. But tune in tomorrow for that. And I'll see you guys then. Take care.